Good morning, everyone. We're going to be talking about Shopify stock today. I must say, you wake up and you see this thing down 7% already. You wonder what the heck happened. We just reported earnings prior to open, so you wonder what in the world could have happened. And in my opinion, and I stated it on my earnings to watch video, this should have been a knockout earnings, absolute smasher. But as a result, you see the stock's down, so it makes me curious on these earnings and what it looks like. So we're going to take a little peek at it and see what's going on. So, just based off these looks, holy crap. A Q4 non-GAAP EPS of $1.58 beats by 37 cents, and a GAAP EPS of 99 cents beats by 35 cents. That's a really good beat in terms of profitability right there. I don't think there's anything to complain about there. Not at all. And then if you look at the revenue line, this is incredible. $977 million, up 93% year over year. They nearly doubled their business, which is a beat by $64 million. I mean, that's an absolute smasher. I don't know what else to say. I personally did think it was going to hit the $1 billion mark. I can't lie to you. I was kind of overshooting, but that's still a really good beat there, all things considered. To see nearly doubling your business year over year. So there's got to be some more details here. We'll see. We'll see looking further if we find something that's making the stock go down. So if we look, general merchandising volume, GMV, products sold with the platform, obviously using the platform, of $41.1 billion, growth of 99% year over year. Gross payment volume grew to 19.1 billion, which accounted for 46% of the general merchandising volume processed in the quarter. Comment from the CFO. Let's see if this is part of it. Shopify was prepared to ship the features that our merchants needed during the pandemic because we had invested several years into the future. That arrived early with the accelerated online e-commerce. Like I said, we were amplifying our efforts in 2021, and we focus on executing our portfolio of initiatives that will further fuel further growth for our merchants and for Shopify. Nothing negative from the CFO, I'll tell you that. What can we find here? And some more of this good stuff. Adjusted gross margin rate of 52.2% of sales versus 51.6% on the consensus, so good on that aspect. Adjusted operating margin rate of 20.5% beats 15.6% consensus. I mean, come on now. Monthly recurring revenue came in at $82.6 billion, which improved from $74.4 million mark last quarter even. I mean, these are good numbers here. There we go. Shopify expects to see growth rates slow in 2021. So, I've said many things about this in terms of growth rates. I don't understand how this is going to get investors scared of the stock, because slow could mean anything. If you're talking about slowing from literally doubling your business, 94% increase in revenue, nearly doubling. Slower could still be an increase of over 50%. I don't understand. It's not feasible to double your business every single year. And I feel like some of these big cats over with the billionaires, I don't know. Bill Cosby just decided to show up out of nowhere, and I don't like that. Get him out of here. Put him back in jail. I don't think I get it. I don't know. I feel like some of these people just don't get it. They just don't understand anything about numbers even. They don't understand numbers. I don't get that. You can't just double your business every single year. It's just not feasible. That if you're doubling your business every year, that means you're increasing your growth every single year in terms of dollar amount too. They can increase by the same dollar amount, but guess what? This year, it's not going to be 100% growth. It's going to be 50% growth. That's just kind of how it works. I'm sorry. Sorry to tell you. Ugh, some dumb people, I'm telling you. Whew, pop some people in the face, it makes me feel like son of a gun. Obviously, that being said, though, you look at the stock, and in the past year, it has gone up 155%. So maybe there's some reason for pullback. I'm not gonna be too absurd. I just think that if that's the reason why it's down, I think people are smoking some serious bad. They're not smoking the good stuff. Okay, whatever it is, they are high as a kite. Absolutely high on farts. So we see for the full year, general revenue grew 86% of the full year. Son of a gun. General merchandising volume grew 96%. That's pretty cool. $120 billion in general merchandising volume for the full year. That's incredible. It's a lot of products sold using these services. A lot of products sold. As far as fourth quarter financial highlights, obviously, we saw the revenue number. Subscription solutions revenue came in at $279.4 million, up 53% year over year, driven by merchants joining the platform. Again, I talked to you about the increase of e-commerce and how everyone's going to need to be part of it to stay relevant. They've got to stay relevant, and they do that by using Shopify platforms and staying on e-commerce. I mean, that's how they do it. Merchant solutions revenue grew 117% to $698.3 million, driven by the growth of general merchandising volume, more products sold on there. Monthly recurring revenue, obviously, we saw very nice growth, 53% year over year. Yeah, pretty nice. Pretty nice stuff there. Gross profit dollars grew 91% to $504 million. So that is pretty nice to see. But again, we kind of want to see the net income line. Net income for the fourth quarter came in at $123.9 million. It's not the best net income line. I mean, we're talking about revenue of $977 million. Net income of $123.9. But again, you talk about a company that wasn't making profit too long ago. It's a good sign for this company because they're growing at substantial rates. Last year they had $50 million only in this net income line, so they quadrupled that in a year. I mean, I don't know what you're saying, but if you look at non-adjusted, they only had $0.8 million. $800,000 was their net income line, and they grew that to $123 million this year. I don't know if anyone can understand the difference there, but we're talking about 150 times the amount. Son of a gun. So that's quite the improvement there by them. Very nice. This is impressive numbers. I've always been a little bit away of this company. I've been shy of it because of the fact that they don't bring in enough profit. And now they really are. And it's pretty impressive. I can't lie to you. Pretty impressive. These highlights are nothing crazy. They're talking about some of the specific regionalized things there. For the full year, obviously, we saw some great numbers. Full year net income came in at $319 million, which compares to a loss of $124 million of last year. So again, I told you that last year they didn't bring in a profit, and this year they brought in a pretty substantial profit. I mean, we're talking about a difference of $400 million in terms of this profit line. That's crazy. That's really good. I don't know. I don't know. It's pretty nice. That's all I can tell you. Here they're kind of just selling the business. It's kind of interesting for the press release. They're selling business. But you know what? It's fun stuff. Obviously, the outlook. They don't give a really good outlook, but all they say is we're going to see a little bit less in terms of growth rate, which isn't a shocker at all. I do want to look at the balance sheet while we're here because we love to do it. What if I enlarge it? Let's enlarge it. That's what I need to do to myself personally, but let's not enlarge it because I want you to be able to see everything, I think the bottom's cut off a little. Okay, so December over December. Look at this full year comparisons here. Total current assets coming in at $6.8 billion compared to $2.7 billion of the year prior. Most of it due to cash and cash equivalents and marketable securities. So obviously they're trying to increase the size of this balance sheet, which is pretty important to me. Total assets in general came at 7.7 versus 3.4. Most of that, again, was just due to the current asset category, as you saw before. Liabilities coming in at $438 million in terms of current liabilities compared to $316. An increase that was not nearly as much as they grew by, so in terms of assets, so mostly just accounts payable. And from a long-term standpoint, when you see a big increase in that, that's where you get a little bit concerned. And you do see here, it was due to a senior note sale, convertible senior notes. So now total liabilities coming in at $923 million versus $157 million. But overall, assets grew by a significantly larger rate than liabilities did. We're talking about equity increasing to $6.4 billion compared to $3 billion of the year prior. This balance sheet's turning into something of dreams, and it will within a year. This is going to be quite the balance sheet. Good grief. They're already increasing it quite substantially, but it's pretty impressive what this company's able to do right now. Obviously, they would not be in this position if not for the specific, unique situations faced in 2020. It would not happen. The acceleration of e-commerce just absolutely took off because, well, people had to shop online. They didn't feel comfortable going out. So businesses were only allowed to sell online. So Shopify saw a major benefit, and I honestly 100% wholeheartedly don't believe they would be sitting in a profitability standpoint this year. It'd be darn close to break even, I think, but they wouldn't be making as much profit as they did this year if not for the pandemic. So this company's got a lot to thank for that. I can't lie. You look at the stock too, which I think it's fair looking at. This PE ratio is going to fall down quite a bit, obviously, after this breakout of a year. Nice quarter. Still very high PE ratio regardless. So PE ratio is probably still going to be over 800, which is not exciting. Market cap at $165 billion when the company overall brought in $2 billion. I mean, you know what I'm saying? Does anyone see what I'm saying here? So the valuation is still so it's overblown, and I guess that could be some reason for pullback today. The valuation is freaking sane. Now, this is a company that's going to see continued benefit in the future, but I just think for the current valuation, I just don't think it's worth it. I don't think it's worth it for the current valuation. If you got on board, last year, I'm super proud of you. But you know what? This stock has just taken off a little too quick for its own britches in 2020. Since the biggest drop down, they were up 300%. And again, as I mentioned, this year benefited them more than anything else. I just think that they're a little bit too big for their britches in terms of stock price. So, yep.